Have you been wondering if it's worth it to buy down your interest rate? Or what's the difference between a permanent buy down or a temporary buy down? Well, you're in luck because today I have expert Tina Ryan with Fairway Mortgage, and she's going to share all about that. So, do you want to introduce yourself, Tina?
I will. Hi, everyone. My name's Tina Ryan. I am with Fairway Mortgage, and I've been doing home loans for a really long time. We'll just leave it like that, like 20 plus years. And Laura brought me in today so I can talk about buy downs. So, we're going to do some math.
Right. Okay, and before we get going, in case you're new here, I'm Laura Randall with Remax Elevate, and I serve Snohomish County and Camino Island. And so let's get to this.
All right.
Okay. First of all, Tina, what is the difference between a permanent and temporary buy down?
All right, great question. There is a difference, and it's kind of a big difference. So the big buzzwords nowadays are these 2-1 buy downs, 3-2-1 buy downs that people are seeing in listings and whatnot. And the key is that these 2-1 buy downs are temporary, whereas the interest rate buy downs, I think that most consumers are aware of, are typically permanent, which means they are going to last the entire term of your loan. If you have a 30-year mortgage, that permanent buy down lasts for 30 years. And so the 2-1 buy downs are temporary. They're only going to last, in that case, 2 years.
Okay, well, how does this 2-1 buy down work? I mean, 2 years, but what is involved and what happens for those 2 years?
Perfect. So it's actually a great tool for buyers right now since interest rates are a little higher than they have been in the past. So if you have, we'll use 6.5 for an interest rate. The buyer has to qualify at that 6.5 rate, but with a 2-1 buy down, you're able to get your first year's interest rate payment calculated at 4.5, and then you'll make a year's worth of payments, so 12 payments at 4.5. Then your second year's payments would be at 5.5, and then at that third year, it goes back to the 6.5 interest rate. So the buyer gets the benefit of having a lower payment for those first couple years.
So how do I go about getting a 2-1 buy down?
Well, depending on the loan program that you have, sometimes the buyer can pay for it. In almost all cases, the seller can pay for it in the form of a seller credit, as long as it's negotiated in your purchase contract. And then the lender sets it up through an escrow account, and it's all done through the paperwork there.
So I have seen in my research for doing this video and looking online, I've seen a lot of online calculators about the 2-1 buy down. So how reliable are those?
Online calculators, like anything online, are probably a little bit reliable. The most reliable thing that people can do is talk to their loan officer, because when calculating the cost of this buy down, it can change so much because it's based on the interest rates, and interest rates change every single day, several times. And it's based on the loan program type, the credit score, everything. So, using an online calculator, you may not know everything that goes into it.
Right. So if I wanted to do a 2-1 buy down, how would I figure out how much to ask or request from a seller, or how much I would need to come up with to pay for this?
Great question. Talking to the loan officer, for sure. We all have our own internal calculators that we can work on. We check the interest rates for that day, and depending on the duration of the temporary buy down, we go through and we calculate how much the buyer has to come in with or the seller credit needs to be, and then you incorporate it into your financing addendum. I think one thing that people should be aware of is that, a temporary buy down is going to typically be more expensive than a permanent buy down. And it's because you get more bang for your buck on the temporaries.
Okay.
when you do a temporary buy down, like we said earlier, you know, maybe we're doing a 6.5 interest rate as the regular rate, and that first year's interest rate is all the way down to 4.5.
Right.
If you're doing a permanent buy down where your interest rate is going to be lower for 30 years, you might be paying a fee to lower your interest rate maybe only 1/4 of a point. So from 6.5 to 6.25,
Right.
but it's good for 30 years. And I think what consumers are realizing is that we anticipate interest rates to lower. So the temporary buy down is giving them a little, like I said, a little more bang for their buck.
So if I was to get a temporary buy down and it was a 2-1 buy down, but in say 13 months, I decided to refinance, would I just lose all the money from paying for that buy down?
That's the beauty of the temporary buy downs. So no, you would not. So with a temporary, yes. So with a temporary buy down, how they work is every month when you go to make your monthly payment, and let's say it's that first year, and you're making your monthly payment at that 4.5% rate that payment is calculated on, the servicer is going to have this bucket of money over here where that credit went into for your temporary buy down. So you're making your payment at the 4.5 rate, and they're going to take out a little bit of money to make the difference at the 6.5 interest rate. So it's an interest subsidy, if you will. And so every month, you know, they're matching whatever interest changes or the difference between 4.5 and 6.5. So we have this bucket over here. So if you still have funds in the bucket when you refinance because rates are lower, or you sell or move or whatever, that bucket, whatever's left in it, goes to your balance. So you get the benefit. On a permanent buy down, you don't ever get that money back.
Okay, so can you give me an example? If I'm looking to buy a home and I'm looking at this temporary buy down, how much could I really save by doing this?
Absolutely. People can save several $100s a month. It's a big savings.
Yeah, that's a big deal.
It is a big deal. So let's just say you had a $600,000 purchase price and you put 5% down, all right? So you are going to have a 6.5%, you know, payment, but you're only making that 4.5% payment because you've got the interest subsidy. So the savings to the buyer in that first year is about $700 a month.
Wow.
Which is big. It's really big. Yes, there's some mortgage insurance in there and stuff because you only put 5% down. But on principal and interest payment, it's great. Even if somebody had 20% down, they're still saving $600 a month. So it's a big deal. And when that interest rate changes from our example of, you know, 4.5 to 5.5, it's still a big savings of over $300 a month.
Wow, yeah, that's significant.
It is. It's a great savings for a buyer, and a great way for sellers to attract buyers to their listing because everybody wants to save money.
Thanks so much for sharing with us today, Tina. And one thing I wanted to note was as I was looking into things, and what I found was that the more I learned online, the less I realized that I knew. So it's really important to contact your lender and get all the information directly from them. And so before we wrap up, Tina, do you want to kind of share what area you lend in or what states you lend in and how people can get in contact with you?
Absolutely. Thank you. Yes. So you can reach me at 206-799-8775 is my direct line, or at my website, tinaryanteam.com. And I am licensed to lend in Washington, Oregon, and Arizona.
Perfect.
Yeah.
Thank you. And don't forget to subscribe to my channel and ding that bell for notifications so you get notified when more videos come out.